All right, let's dive right in. Today we're going to crack the code on a really powerful and honestly a kind of misunderstood force in the global economy. We're talking about the deep, hidden connections between a country's money, its interest rates, and what its currency is worth. So how does it all fit together? Let's find out.
You see this stuff in the news all the time, right? The dollar is up, the yen is down, but what's the deal with how much these values jump all over the place? It often seems like there's no rhyme or reason to it. Well, that right there, that's the central mystery we are going to solve today.
To get to the bottom of this, we have to build a little model of the economy, starting from the inside out. I want you to think of it like we're building a machine, and our very first stop is the heart of that machine, the engine room. In economic terms, we call this the money market.
So, first things first, what even is money? It's not just about how much wealth you have. It's really about liquidity. How easily can you use something to go buy stuff? Cash in your pocket? Perfect for buying a coffee, but it earns you zero interest just sitting there. On the other hand, things like bonds or property, well, they can make you a lot richer over time, but try paying for groceries with a stock certificate. It's this constant trade-off, right? Convenience versus earning a return. Okay, so who's at the wheel here? Who controls all this super liquid money? Well, that would be the central bank. In the US, you know it as the Federal Reserve. They're the ones in charge of the money supply, which is, for our machine, the total amount of fuel available to the economic engine. But it's not just about how much fuel is available. It's also about how much the engine needs. We call that money demand. So what drives it? It's really three main things. First, interest rates. I mean, if you can get a great return on a bond, holding on to cash that earns nothing, that's a costly choice. That's the opportunity cost. Second, prices. Pretty simple. If everything costs more, you just need more cash on hand to live your life. And third, national income. The bigger the economy, the more buying and selling is going on, and all those transactions need cash to make them happen.
Okay, so we've got our fuel, the money supply, and we've got the engine's need for that fuel, money demand. Now, when you bring these two powerful forces together, they turn the most important gear in our whole economic machine, the interest rate.
In economics, this balancing point has a name. It's called equilibrium. You can just think of it as the sweet spot. It's the point where the amount of money the central bank is putting out there is exactly the amount that people and businesses want to hold. And that's where the interest rate naturally settles.
So let's play this out. How does it actually work? Imagine the Fed decides to pump more money into the system. All of a sudden, people have more cash in their accounts than they really want or need. So what do? They're not just going to sit on it. They'll try to buy something that actually earns a return, like a bond. Well, when everyone rushes to buy bonds, that surge in demand pushes the price of those bonds up. And this is the crucial part. When bond prices go up, interest rates go down. It's a mechanical relationship. So remember this, more money in the system equals lower interest rates.
So, our domestic engine is up and running smoothly. Now it's time to plug it into the rest of the world. We're about to see how that main gear, the interest rate, has a huge and direct impact on the value of a currency out on the global stage.
It really boils down to this. Think like a big global investor for a second. You want to park your money where it's going to earn you the most, right? So, a country that's offering a high interest rate is basically offering a better return on its money. It acts like a giant magnet for cash from all over the world.
So let's trace the dominoes here. Step 1. The U.S. increases its money supply. We just learned what that does, right? Step 2. U.S. interest rates fall. Now, for those global investors, the return on holding dollars just got a lot less attractive. So, step 3, they start selling their dollars to buy other currencies that offer better returns. That means, step 4, demand for the U.S. dollar falls. And what happens when demand for something falls? Its price drops. Step 5, the dollar depreciates. See that? It's a direct chain reaction.
But, and this is a big but, here comes the major plot twist in our story. This economic machine we've built, it doesn't work the same way all the time. We have to bring in the idea of time, because the rules of the game are totally different in the short run compared to the long run.
The key idea here is something economists call sticky prices. In the short run, like today, this week, this month, prices for things like a gallon of milk or your monthly salary are slow to change. They're kind of stuck. Think of it like trying to turn one of those massive container ships. It just doesn't happen on a dime. But in the long run, given enough time, that ship eventually turns. Prices and wages adjust to the new reality.
And this is what that long-run reality looks like. After that container ship has finally made its turn, a permanent increase in the money supply doesn't actually make the country any richer. It doesn't change real interest rates. It just means everything costs more. If you double the money, eventually prices just double too. This is a super fundamental concept in economics, and it's called monetary neutrality.
Okay, you with me? We've got two different speeds happening at the same time. You've got the lightning-fast reaction of financial markets in the short term and the slow, grinding adjustment of prices in the long term. And when you put these two completely different timelines together, you get the solution to our entire mystery. You get something called the overshooting effect.
So it all starts with a shock to the system. The central bank makes a big announcement. They're going to increase the money supply. And that news flashes across trading screens all around the world in an instant. Financial markets do not mess around. Bond traders and currency traders react in seconds, not months. Just like we saw, more money in the system means interest rates drop, and they drop right now, instantly.
But at the same time, back in the real economy, things are moving at a snail's pace. Your local coffee shop isn't instantly changing the price of a latte. Your boss isn't calling you in to renegotiate your salary. Remember? Those prices are sticky. They're slowpokes.
And this right here, this is the critical moment. You have this massive mismatch in reaction speeds. The financial world is already adjusted, but the real world is still stuck in the past. Something's got to give. To make the math work, to balance everything out, the one thing that can move instantly, the exchange rate, is forced to
Overshoot. It has to do all of the adjusting for everyone else. Because prices aren't helping out yet, the exchange rate has to overreact. It has to go way further than it otherwise would. So what this means, in plain English, is that the currency's initial drop is way, way bigger than where it will eventually settle down in the long run. The exchange rate has to fall off a cliff in the short term, basically to do all the heavy lifting and compensate for those slow-moving, sticky prices in the rest of the economy.
And this is the answer to our question from the very beginning. This overshooting dynamic is precisely why we see those wild swings in currency markets. The market's first reaction is a massive overreaction. And then, over time, as the real economy slowly catches up and prices start to adjust, the exchange rate can climb back up to its new long-term level. That initial huge swing, that's volatility.
So let's just run through that logical chain one last time. The money market sets the interest rate immediately impacts the exchange rate, but because real-world prices are sticky and slow, the exchange rate has to overreact in the short term. It overshoots, and that's what makes currency markets so volatile.
And that leaves us with a final, really interesting question to chew on. We built this whole machine, and we've shown that overshooting is a predictable effect of a policy change. But if we know it's going to happen, why is managing a real-world economy still so unbelievably difficult? It seems like there's always more to the story. Something to think about. Thanks for joining me.